Hi everyone, welcome to another episode of the Patient Wanted channel. Today we're going to talk about a framework that helped me turn this chart to my most profitable investment ever. This is the Meta Platform's drawdown chart, and between September 2021 and November 2022, I bought 21 times and subsequently selling all my shares, turning £3,196 to £8,636 for a profit of £5,440. This framework is 4 simple steps that everyone can follow, so let's jump straight into the video. Last week on Thursday, the S&P 500 dropped by 1.66% and the bears came out. Meanwhile, as you can see from the chart here, it was a small dip. The fear and greed index went to extreme fear and everyone was talking about the new bear market. Even though the S&P 500 year-to-date performance is up, as you can see from this chart here, the maximum drawdowns are pretty significant. You have tech with a maximum drawdown of 26.2%, discretionary with 26.3%, so this shows that there is a lot of volatility in the market, even though the S&P 500 is up year-to-date. You might be one of those people that are not impacted, but I'm sure a lot of people are, and let's look at some examples. Meta drawdown is 24.4%, Palantir 21.2%, Oracle 35.6%, Adobe, which is part of my portfolio, 29%. And looking at smaller companies, we have Duolingo with a drawdown of 66%, Oklo with a 47%, CoreWeave with 60%, and Hims & Hers with a 50%. These are very popular amongst retail investors, and in my opinion, volatility is a friend of the long-term and patient investor. However, we also know that the S&P 500 is trading at historically elevated valuations. I took this chart from one of Howard Marks' memos, and it shows the S&P 500 forward PE ratio against the subsequent 10-year returns. And you'll see as we cross the 22 times forward PE mark, the next 10 years total returns is below zero. Currently, the S&P 500 forward P ratio is at 23 times, which suggests we are at historically elevated valuations, and we can all try and predict when the next bear market will be. However, that's extremely difficult, and I prefer to create a framework to allow me to be ready when it comes, no matter when it comes. Going back to 1970s, bear markets come for various reasons. In 1970s, we had the oil crisis. In 1980s, we had the Black Monday. Early 2000s, we had the tech bubble. 2007, 2009, we had the global financial crisis. And 2020, it was the COVID-19 pandemic. So what I'm going to do, I'm going to show you my framework, which is a 4-step plan that everyone can follow, which will help you not only survive a bear market, but will help you buy the dip and make a lot of money. But before we get to the steps, like the video and subscribe to the channels. Step number 1, understand what you own. Do the research, read reports, follow KPIs, and join the earnings call. You are buying a business and the underlying cash flows. And at the end of the day, volatility is part of the game, so take advantage of it. Remember, you are not buying the ticker, you cannot control the price, and I think nobody knows where the price is going. And please do not buy a company because someone else bought it. Step number 2, understand why you own them. What's your investment thesis? What's the role of each company in your portfolio? You'll see here a screenshot of my portfolio. The value is £16,981, and the allocation is Amazon, Alphabet, S&P Global, Adobe, and Fair Isaac. I can summarize why I own each of these companies very briefly. Starting with Amazon, they are the leader in cloud computing with AWS. They plan to double their capacity in the next 2 years and benefit from robotics and automation. They also have the side projects, and I expect Project Kyber to be a significant contributor to their growth. And the company continues to expand their margins over time and is investing the most in CapEx relative to its peers, which I think is one of the competitive advantages of Amazon. Moving on to Google. Google owns world-class assets including Chrome, DeepMind, Gemini, Google Cloud, Waymo, YouTube, and on and on and on. When I started investing in the company, the narrative was that OpenAI would disrupt their business, and I thought that was wrong, as I saw Google as a leader in AI and the most vertically integrated player out there. S&P Global, it's a service and data company. As yields come down, their rating business should pick up, which is a high-margin business. They get a fee every time someone invests or benchmarks against the S&P 500, and I do expect AI to help them grow their margins over time due to productivity gains. Next up, we have Adobe. The market narrative is that the AI will kill their business. I think the market is wrong. They are layering AI in their existing products, introducing new AI products, and act as a platform with their own models and also providing third-party AI models. As long as management continues to execute, I expect sentiment to shift and the stock price to re-rate. And lastly, FICO. FICO is the leading credit scoring service provider. They embarked on a journey to raise their prices and the stock tanked because the FHFA came out and criticized them, introducing Vantage as one of their competitors. My own thesis is twofold. One, the best model will win, which I think is the FICO 20 model. And given FICO is entrenched in the industry already, it's going to be hard to displace them. And number two, I expect two things to keep happening slowly over time. One is yields will come down and FICO will benefit as the housing market will be revived. And number two, they will continue to raise their prices as I think the value they add in the chain is more than what they charge today. And lastly, what is the role of each of these companies? Today, my current investment goal is to build a solid base for my portfolio, which includes high quality businesses that I expect them to continue to grow well into the future. And all 5 of them are high quality businesses that I don't worry about on a day-to-day basis. I expect them to act as a good base to build on my portfolio to 6 figures and beyond. Step number 3, try to focus on data and remove emotion. This is one of my favorite charts which illustrates step 3. The red line is Adobe's stock price and the blue bars is the free cash flow on the last 12 months basis. As you can see, the stock price was following the free cash flows with the exception of 2020 and 2021 where the company was, I guess, overvalued as the stock price peaked, then it corrected, then it went overvalued again between 2023 and early 2024, but then around August 2024 there is a disallocation as the stock price dropped while the free cash flows are sitting at all-time highs. So looking at the data allows me to remove emotion as I think free cash flows is the ultimate weight that will determine the stock price in the long term. As the stock price goes down, I keep buying Adobe. And lastly, number 4 is have a plan. Ultimately, what I'm trying to answer for myself is what will I do if my stocks drop by 50%? Personally, the plan is if they drop by 50%, I'm doubling my positions as I consider these high quality businesses. And assuming that fundamentals don't change materially, I'm going to be doubling my positions. There is also this element where personal finance of what happens outside your investment portfolio comes into play, but I'll leave that for another video. So that's a 4-step plan, which is very simple. Understand what you own, understand why you own them, try to focus on data to remove emotion, and have a plan. Ultimately, following this framework will allow you to not only survive a bear market, will help you buy the dip, remain invested, and make a lot of money. Going back to this chart and I'll finish the video, you will see that over time, the bull markets are longer and higher than the bear markets. So the goal here is create a plan to help you not panic, remain invested, and buy the dip. That's it for this episode. Like the video, subscribe to the channel, and I'll see you in the next one.